Welcome to the latest episode of Quest for Twice. Last week was a busy week with the earning reports. So I'm going to provide an update on several companies' latest earnings. The first one is Amazon. So Amazon had a fairly strong fiscal first quarter. Had a sales of 4.5 billion, up 8% year-on-year, and also increased the EBITDA margin by 80 basis points. What's more important is Amazon increased its guidance for fiscal 2022. So as shown on the right-hand side table, so the net sales growth went up for both segments, including automation solutions. The previous guidance was a 6 to 8% sales increase. Now it's a 7 to 9%. And the commercial and the residential solutions was increased even more by about 3 percentage points. So the commercial and the residential markets are very strong, and Amazon provided the breakdown in those markets, including the residential market is forecasted to grow by mid-single digit. Commercial and the industrial section will grow by high single digit to low double digit, and the tools market will grow by double digit. Amazon also updated the trailing 3 months underlying orders versus 1 year ago. So we can see in this graph that the commercial and residential solution, the orders came down from the previously very high number, but now has stabilized around 15%. And the automation solutions picked up steam. Now has in December reached 19%. That is the basis for Amazon to increase its fiscal year financial guidance, because strong orders and backlog in Q1 will convert into sales in the remainder of fiscal year. Automation solution backlog now is at 6 billion, up 0.5 billion from previous quarter. And the commercial residential solution backlog is at 1.3 billion, and also increased $150 million Q on Q. Amazon also provided the earning updates. So the sales went up by 10% year on year. So it's a deceleration compared to 15% year on year increase in Q3. The operation income came down 50% compared to 1 year ago, and compared to down 22% in Q3. And that's driven by higher labor cost and higher logistics cost. And those are in line with the Amazon's guidance given in the Q3 earning reports. As I mentioned before, I look at the higher labor cost and higher logistics cost as an investment to make sure the customers are happy during the important holiday season. And I believe the investments were well made. So an evidence of that is Amazon announced it planned to raise a Prime membership fee by 17%. So basically, Amazon provided a good service in the holiday season to demonstrate its value to its customers. Afterwards, Amazon is asking for in my opinion, a fair raise of a price to compensate for the higher cost and good service. I believe its customers may not like it, but they will pay the higher membership fee. So let's take a look at Amazon's sales growth in its various segments. So basically, the online first-party sales, third-party sales, and the physical sales going back to normal. So for the online and the third-party sales, those are decelerating growth. However, the Q4 sales growth is decelerating not as steep as Q3. So I believe it'll stabilize in this year, and then just keep growing with the overall e-commerce. The ads sales also coming down to the historical norm, about right above 40%. That should be expected, given that the very high ads growth in the last several quarters were impact of the pandemic, since a lot of small retailers moved online, and they spent the advertiser money to generate the sales on Amazon's platform. But even the historical advertisement revenue growth of 40% or more is very high. And also importantly, AWS is still going strong. It even increased compared to the previous several quarters. We can see in the last 2-3 years, the AWS growth rate is fairly consistent, and it's very high. And that's a very powerful revenue and profit engine. Lastly, the subscription revenue that includes the Prime membership. It declined slightly compared to the first 3 or 4 quarters. However, as I mentioned, the price increase is coming, so we can see a similar effect at the end of 2018, a significant revenue growth from about 25% to over 40%. And I believe that's because of the previous Prime membership fee increase in 2018. So I expect that we're going to see a similar growth in 2022. So just quickly revisit my original investment thesis and the risks. So the thesis was to buy a growth company at a reasonable price. I believe that is still true. And the key indicator of a gross margin is a little higher in 2021 to 26% compared to 2020. That's despite the cost increase I mentioned earlier. So I do believe the future sales growth may slow down, but the earning growth is sustainable, will be driven by subscription, AWS, and advertisement. For the risks, Microsoft and Google are also growing their cloud service rapidly, but there is no sign AWS is slowing down. So lastly, the current price to sales ratio is at 3.5 compared to 3.9 in August last year. So that is the same as the average prior to COVID-19. So I think that is an indication of the current price is fair. There is still a lot of growth runway ahead for Amazon. Ingredient also reported the Q4 earning, and that was disappointing. So as shown in this table of the key financial metrics for each quarter in last year, the main problem is the gross margin. That's a significant decline from 1 year ago and also from previous quarters. That's driven by high corn price inflation. So although ingredient increased its sales, but its cost also increased. That's why the gross margin declined. And also there are some unforced errors, including slow ramp up of the new plant for making plant-based protein. There was also COVID-related labor issues at some of the plants, resulting in the production below capacity. High transportation cost also decreased the profit margin, and that's also related to the COVID interruptions. Although many of these issues were one-time and should not be recurring, I still think the management did not execute its strategy well, because comparing to AdCore, for example, that was similar issues probably existed for AdCore, but AdCore still executed very well. The silver lining for Ingredient is its growth story is still on track, and its specialty product mix is at 33%, on track to reach its target of 34 to 36% in 2023. Ingredient also provided the 2022 outlook, including revenue and operation income increase compared to previous years. However, Ingredient did warn that its first quarter results will suffer with about a 10% reduction in ops income due to still high current cost. So there are some headwind in short term. However, Ingredient stock price has been punished significantly. So at the current stock price of about $86 per share, using its forecasted 2022 earning of $7.15, its PE is about 12. So I think the current price has adequately priced in the headwind from the high current cost. The last update is for Walker & Dunlop. So Walker & Dunlop had an outstanding Q4. Since it takes a cut from the transactions it facilitates, so the most indicative number to look at is the transaction volume. So in Q4, the transaction volume was $27 billion, which was outstanding given that the transaction volume for previous years before 2018 and 2017 were about the same and even less than a single quarter in Q4 of last. And adding all 4 quarters in 2021, and we can envision that that bar is off the chart on this slide. Its mortgage service right is an asset, so will generate a future service fee. So at the end of last year, its MSR stands at about 116 billion. So it's a single-digit increase from 1 year ago. It's not much to talk about. However, its property sales division really delivered. So in the first half of last year, its sales was 4.7 billion. And in the second half of last year, including the outstanding Q4, its sales reached 14.5 billion. It's almost 10 billion more than the first half. That's truly impressive. We are ready to look at the revenue for the Q4 compared to Q3 and also compared to the previous several years. Its loan origination unit is generating very healthy revenue growth. Its mortgage service right is holding steady, as I mentioned earlier. Its servicing fees are also holding steady with a slight increase. What outstanding is its property sales commission really has exploded. In Q4 of last year, the revenue was $54 million in a single quarter. Compared to the year 2020, the whole year revenue was about $26 million. So as a result, its Q4 revenue increased 10% from Q3, and also the whole year revenue increased significantly compared to 2020, which was an outstanding year. On the expenses side, the most important number is at the bottom of this table. The operating margin, 27% in Q4, is the same as Q3. The reason it has declined by several percentage points compared to previous numbers was because of the higher personnel cost. It was 48% of Q4 revenue, and that's because of the lower contribution from MSR revenue. That's because of the property sales fee-based and commission-based comparing to the MSR assets generation from making loans on behalf of the GSEs. So we can look at the EBITDA as a cash proxy because it removes MSR impact. So as shown in this chart, the total EBITDA in 2021 was over $300 million, significantly higher than previous years with a very healthy growth rate, especially in Q4. Its EBITDA is over $100 million. That's truly impressive. Consider the Q3 and the first half EBITDA were already very healthy numbers. So in summary, Walker Dunlop is generating a lot of cash and plenty to cover its dividend and share buyback program and income tax. It recently refinanced its debt in order to buy Alliance Capital. So now the EV over EBITDA is 16.2 at $137 per share, using the $309 million 2021 EBITDA. And 2022 EBITDA growth outlook is double digit, considering Alliance will be contributing to EBITDA and its natural momentum in the property sales. The EV over EBITDA ratio of 16.2 I consider as fairly valued or a little undervalued for its growth potential and very strong cash generation. So this concludes this episode of Quest for Twice. Until next time, happy investing.